Um, so so Rich, did you know that I think that one of the leading causes of home accidents are ladder. Oh, can you hear that?
No,
You can't hear that church bell?
no.
It's high noon here in Larkspur, California. But um, anyway, leading cause of accidents, I think, is people falling off of ladders. So be careful when you're putting up those stockings with care.
I've already put up all the outdoor Christmas decorations without injury or maiming somehow. So yeah, I'm the guy with like 9 blow ups in the front yard and all kinds of obnoxious, funny stuff going on. I heard that crow in the background. What is that? Some manufactured housing in the background there?
Well, unlike it's a, I'm surprised you can't hear that church bell, but the out here in California, Larkspur, California, it's actually still autumn. Unlike Twinsburg, Ohio, where apparently you've overtaken Costco in terms of it being Christmas. So congrats on that.
It
Forget. Oh,
oh
there we go.
boy. All right. This is evidently our new promotional graphic for the 12 days of
That's.
TNC editions of
I think that's. I'm gonna put. I'm gonna. Can I get hard copies of that so I can use it for Christmas cards to the family and friends this year?
we'll get you a couple hundred in the mail.
Okay.
So
Good. Good.
all right. Well, happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. As always, pleased to be joined my esteemed colleague and co-host, Rob Chrisman. Rob, great to see you.
Good to see you too.
What
Good to
brings
see
you
you
to
too.
Larkspur, California today for the location shoot?
Yeah, I'm on location in Larkspur. Well, my one a couple months ago, we actually broadcast from my daughter's seventh grade classroom, which I'm looking at down the street. So I'm not Larkspur is about 15 minutes north of the Golden Gate Bridge, up Highway 101 in California, and in about an hour, I will be having lunch with the owners of Bay Equity. Well, I guess that's Redfin, but the old owners of Redfin or Bay Equity and some other mortgage folks. We get together once every 2 or 3 months for a lunch just to shoot the breeze about mortgage banking and the mortgage world. So it'll be interesting because Redfin has been in the news this week with being downgraded and then eliminating part of their business line.
Mhm.
And so it'll be an interesting lunch. But yeah, the climate is nice out here. It is still autumn, and yeah, there are crows or ravens. I think they're crows. I don't know,
It
flying
came
around. So
from somebody send a raven to you with some news. So you did you watch Game of Thrones?
I'm not. Yeah, it's like Harry Potter with an
Were
owl.
you
No,
a Game of Thrones guy? I forget.
I haven't seen Game of Thrones.
Wow. Wow. I've heard you referred to as the Lord Varys of the mortgage industry. So, which is a compliment, I think. So,
But and not a
any
compliment. Okay.
Lord Game of Thrones fans in the audience can make their own determination. But let's
No.
go ahead and get into it. And a busy week, Rob. Obviously, election day this past Tuesday, with not quite what was expected in terms of the results, and still more results to come. Elon Musk and Twitter just continues to be in the news, and crypto, another big crypto company failed. But most notably, as it relates to our industry, the consumer price index release on Wednesday morning. We've been talking, we need that one big, better than expected inflation number. And at least for one, we got it Wednesday. CPI expected to be up 0.6% month
I
over
think I think yesterday, right?
yesterday. I'm sorry. Yeah. Up only 0.4%. The core number when you strip out energy and food, also 0.2 below expectations, setting off a wild rally on Wall Street. Stocks have gone absolutely crazy. And a mortgage bond rally, the biggest mortgage bond rally in a decade. We've had so many, biggest in the 20 years, 30 years. Evidently, yesterday's rally was the biggest in a decade now, again, coming from a deep, dark place. But your thoughts on action-packed week?
I thought it was a pretty good week. The the election, I don't know I don't know who, I don't follow politics, to tell you the truth, much really, because it's not much fun for me. But when you talk about election results not being what were expected, I don't exactly know what was expected. I know Donald Trump was out making forecasts, and Joe Biden was making forecasts, and Barack Obama. I mean, a lot of forecasts out there and a lot of vote counting that's still going on, and so forth and so on. I think in general, though, um, well, I haven't heard the latest. It's nice to have a difference of opinion in terms of Congress and the House of Representatives and the Senate and the administration. It does tend to promote gridlock sometimes, though. But I mean, look at the Biden's first couple of years. There's a lot of detractors and a lot of proponents and a lot of people criticizing the first couple of years, and a lot of people saying, you know what, things are going pretty well here. Sorry, there's some squirrels playing back there because it's still autumn out here. But the fact of the matter is, obviously, Congress doesn't directly influence the Federal Reserve. So the big news, I think, yesterday was the consumer price index, and you talk about the core rate ex food and energy for those people out there who don't use energy and who don't eat, lower than expected. And I think that you're right. Coming from a deep, dark place, we were down. It's like a a child who gets beat every night, and then one night there's no beating, and it's like life is wonderful, right? And so, and I know that's a little bit of a
It
stretch,
tells you
but
what kind of year it's been for the mortgage industry. That analogy.
right, yeah, it's like and so when the blows stop coming, like yesterday, it's like Yahoo, we're going to celebrate the little things. So the fact that it came in less than expected was good. Now they're talking about a half a point increase in the targeted Fed funds rate in the December meeting versus 3/4 of a point. We'll take what we can get. And if it helps mortgage rates, that's great. I don't necessarily see the trend in rates going down. We're still not through the woods here. Inflation is still running at what, 7.7% annualized. It's still a strong rate of inflation that the Fed has to contend with, and the Fed is playing catch up and will continue to play catch up. But it was nice to see a little bit of a bounce. And unfortunately, my heart goes out to everybody in capital markets who has to hedge pipelines suddenly with a big rally like that. Capital markets people are fine, and steady markets, or markets that are going a little bit up every day, or a little bit down every day. But when you get this volatility, it drives up hedge costs and creates a lot of problems. And any loans that were locked in, for any companies out there who have loans to lock in that were locked in, it's like, oh, well, we want it, the borrower's going to walk unless we give them that or something. And so capital markets people are dealing with that. But overall, it was nice to see a little bit of good news. It certainly beats the numbers that we've been dealing with all year. So yeah, it was good news. And then of course there's some critics out there who will find fault with something. No matter how good the news, they're going to complain about something. And so there were some people out there talking about this, that, and the other thing. But nonetheless, the number was pretty good, and I think the industry needs that right now.
Yeah, certainly not out of the woods. Not going to be a big refi boom dropping at 7.5% or whatever the hell has happened the last few days. But it's a
Yahoo 6.75% on the 30-year fix.
Step in the right direction. There's so much fear, so much falling knife priced into the markets, the bond market especially, that we get good numbers like this. We're going to get big rallies because there is a lot of kind of over fear almost. The don't want to be caught holding the bag sellers that got out. So we'll see what happens. But again, it was positive news, and it was for those the Fed and the whole stick the landing thing. It's one step closer to sticking the landing, but many more numbers before it's stuck.
Yeah, I think this week I was fortunate to spend some time in Atlanta with the Atlanta mortgage bankers, and the week before that I was in Wisconsin in the Dells with the Wisconsin Mortgage Bank Association. The attendance was very good at both events. The mood was very good. It's nice to see everybody, as you know, when you have mortgage collaborative events. It's nice to see everybody in person, and the mood tends to be pretty good. Nobody's bragging about their volumes, and I think in general, people who have been around the industry for a while understand that the last 2020 and 2021 were unequaled years. And so there is some sense that we are returning back to a normal environment where, I don't know, call it $1.5 trillion, $2 trillion, whatever volume comes in at 2022 and then 2023. There's just a sense of a little bit of returning to more of a sane market, just like in real estate values, kind of the same things going on, especially in the heartland of America. It's like, we don't need 20% appreciation a year. It's not a good thing. So if we slow down the appreciation, that'll actually help not only first-time home buyers, but you don't want a lot of froth in the housing market. You don't want a lot of froth in lending either. And so to come back down to more normal levels, I don't think it's such a bad thing.
Some other stuff in the news this week: mortgage delinquencies officially hit all-time record low levels. Some good news with strong employment in America, and good for the capital markets, secondary markets. Ultimately, credit risk, a huge component of rates and what people will pay for mortgage bonds. So that's good news. Some more vendor M&A, a couple of the LOSs, the Meridian Link, good partner at TMC's for a long time, made an acquisition of Open Close, one of the other LOSs. So, people are kind of jockeying for position, the whole Ellie Black Knight thing, what will happen there, if anything. And, people trying to move the chess pieces around the board. And another non-QM lender, Angel Oak, looks like throwing in the towel. Rumor being Cross Country could be looking to pick them up. You say no.
No,
Cross
I'm
Country's
shaking my.
lawyers are happy because they're really busy right now.
So, boy, I hope I'm not spoiling anything here. But when I put that rumor in my commentary on Wednesday, who calls me but Ron, the owner of Cross Country, and he had taken offense, not offense. He wanted to correct the story out there that they had laid off 100 people in Colorado. So I'm sitting there talking to him in the airport, and he said, "Hey, I just wanted to talk to you about your mention of Cross Country in today's commentary." I said, "Okay." At least it wasn't Cross Country's general counsel calling me, which is a good thing, right? So Ron says, "Hey, the thing about Angel Oak, yeah, that's true. That's true. But what's false in your write-up is the Colorado layoffs." So I said, "Hey," I said, "no problem on the, I'll put in a retraction yesterday." And he said, "That'd be great." I said, "How are things going?" He goes, they're going okay." He sees a lot of opportunity in the market. And that was kind of the conversation. So I'd say that it's not really rumored. I'd say it's pretty true that Cross Country is doing that. There's a lot of opportunity. I had dinner in Atlanta with a company, Highland, and they are very excited about the current market. They freely admit volumes are down, and rates are up and so forth, and revenue's down, but they've done a good job of saving their money over the last couple of years, and they see, going back to the fluff being taken out of the market, they are looking to pick up branches and loan officers and talent at not so inflated levels. So they view the current environment very constructively, and I'm hearing a little bit of that more and more as I travel around. There are the people saying, at some point we're going to come out of this, And we want to continue to build the foundation now in terms of branches and in terms of originators who will get to know our system and get to know our policies and procedures and underwriters and so forth. So that when, if rates do creep down a little bit or purchase volume picks up a little bit, we'll be in a good place. So it's nice to see kind of those green shoots that are sprouting a little bit out there, rather than some of the doom and gloom that we're used to.
Yeah, no, without a doubt. And it's, who owns the company and how much money do they have? That question right now has never been more important in the mortgage industry. Cross country, guaranteed rate, single owners with literally unlimited amounts of money. That is a massive advantage in any industry, but especially one where everybody's pulling back and you got a lot of M&A and you got a lot of consolidation. So, listen, it doesn't matter what you invest in, if it's stocks or sports cards or mortgage companies. A great time to invest is when things are down and you're seeing a lot of people with a lot of money and aspiration investing a lot of money into the future of their company in our industry right now.
Sports cards.
Sports cards market is down big time right now.
Is it?
I mean, it's still it's down from the pandemic boom. Not quite the percentage of stocks, but it's still up from before the pandemic. But it's down year over year overall, probably like 15%, 18%.
Were your ears? I was on a bike ride recently with my son Robbie, and your name came up. I don't know if your ears were burning, but we were talking about NFTs because I went to brunch last weekend with Augie Del Rio of Gallus, and Augie's wife Paulina is in the NFT business, the non-fungible token business, after having spent time working at the NBA. And so I was talking to Augie about Gallus, and we were talking about NFTs and so forth. And I was telling her about my baseball cards and how you just like pay a dime and you get a pack. And I'm sure they weren't doling out like Nolan Ryan rookie cards back then. But I was talking to Robbie about NFTs and the fact that it seems like supply is artificially limited by who's ever creating these NFTs, unlike some of these cards that you see. And so Robbie's like, well, look at Rich, he was just, he's maybe you should start buying sports cards like Rich does. And I said, I've got a lot of sports cards already. He goes, well, why don't you sell them? I said, well, I don't want to sell them. I mean, there's no, like the bid ask spread is too big. So I had, that comes up every once in a while. It's like, why don't you sell I've got like 3 or 4 Nolan Ryan rookie cards.
Do you really?
Sitting in a binder in my basement.
Oh
And he goes, he says, those aren't doing you any good. I said, well, what am I going to get? Like $500 each or something for them? What am I going to do with,
More than that. I mean, a Nolan Ryan rookie card, that thing is in good shape. That's worth a shitload of money. Oh my God, you got 4 of them?
Watch your language.
Just send them to my address in Twinsburg. I'll assess them.
There's Seventh-day Adventists on this call, Rich. Didn't swear.
Sorry, when you have 4 Nolan Ryan rookie cards, you got me a little excited. That's a
anyway. So you talk about sports cards being down. Well, that's too bad. But yeah, to take some of this froth out of whether it's the real estate market or the ranks of lenders, I don't think it's such a bad thing. But a lot of lenders out there and vendors to some extent are really cutting things to the bone in terms of staff and so forth. So I think there's a lot of talent to be had out there in terms of personnel. Now, I'm outside, and so I can't see the questions or the chats that are coming up. I kind of see the window, but there's too much glare. Is there any questions that we should be addressing before moving on?
That's
Any
right.
comments?
You caught some criticism that you've gone too big time and we're ignoring the comments and questions in the chat. I forgot about that. So there was a question. Somebody noted the Ken Griffey Jr. Upper Deck rookie card. in the chat there.
Nothing up my sleeve.
Iconic
Look
baseball
what I
player.
go to bed with every night.
So what else in the news? A lot of M&A.
Wait a minute, Rich. So like if you're having a tough phone call or something, if you're getting ready to, lay off Tony or Amy or, Tom, if it's a rough phone call, you turn around, look at that card. Does that give you some hope and spirit and inspire you? And why is that within reach?
I talked to him during the day before the show. Like, give me the strength to get through this 40 minutes with Rob, please, Ken Griffey.
You're lucky I have a sense of humor sometimes.
Like the Christmas lights, I'm all about atmosphere, creating a comfortable environment to work in. So,
right. Any other questions? Anything else pop up?
Let's see here. Rob, as companies are adding these people for their future value, how are companies training those folks after cutting a lot of their learning and development resources? Great question.
Right. That's a very good question. I probably get 2 or 3 emails a week from people asking for training sources, whether and at all different levels. Whether you talk about Xenix, Ginger Bell's out there doing some things, Carl White. And anytime you make a list, and I realize I'm going to leave off people and I'm going to get emails like, why didn't you mention our company? Mortgage educators or whatever it might be. David Luna, there's different training sources at different price levels based on what you're trying to accomplish. And I think that people have tended to, or companies have tended to move toward outsourcing that rather than keeping an in-house training staff per se, because things are cut. But I think the training to some degree is being outsourced to other companies.
Yeah, my take would be lenders never have more in-house training resources than they do now, less of that internally, and they are deeply underwhelmed by the external options that are out there. So I think you'll see some different things coming, including some stuff from us to help there.
Yeah.
That has been one of the biggest things that our members have told us ever since the pandemic, really, is that the need for better external training.
But also, not to cut you off, which I guess I just did, but there are some great loan officers out there who have extra time to be mentors or to do best practices. What does it take? They certainly have 30 or 60 minutes during the call to have a company-wide best practices phone call for staff, new staff, especially, to be trained by somebody who's been through a few business cycles or one of their top loan officers. They can certainly spare that time to help mentor or train people within the company. And so I would expect that a lot of companies are doing that out there.
Yeah, they should be, right? Learn from the best and what makes them successful. And like you said, definitely a little bit more time to do that as well. Another question just came in. What's your take on assumptions with about 25% of all outstanding mortgages assumable? Do you expect the caps to be lifted to expand the usability of the device?
Were they talking about FHA loans?
I think, I don't, if Tom is on, maybe he could clarify more. I don't know 25% of all loans out there right now to be able to be assumed by somebody else. Maybe he was talking about FHA loans.
That's a great question that I have. I'm not even, here's Tom LaMalfa tuning in. I don't know the answer to that.
Okay.
How'd Tom LaMalfa get on here?
Yeah, well, he, the topic has come up, assumable mortgages, just with it, so hard for a first-time home buyer to buy a house in today's market. Could some kind of expansion of that where, mom or dad or somebody could buy the house and put it in their name and eventually kind of assume it over to somebody, but that's tricky.
Tom, you there, Tom? Tom's on here, but it appears that he's muted, which is
I unmuted him. I am trying to get him, actually just promoted him to panelist to see if that'll work.
And he did put in the Q&A, all govies are assumable.
Yeah.
with some.
So maybe it might
caveats.
be
So that was
20,
the,
25%. I don't know. It certainly makes a lot of sense. And apparently Tom is ready to talk.
Hi, and indeed I am. Good afternoon.
Hey, Tom.
Yes, it's my understanding that all government loans are assumable. There's a small cap, I think 5 basis points or $900, whichever is greater. The problem is that the cost of originating, processing, underwriting, and closing exceeds that cap. And therefore, that market isn't in a position to expand. In terms of the aggregate, FHA accounts for about 20% of originations and has over the past 5 years. VAs are another about 5%. And depending upon the rural, that's another 2 to 5%. So based on that, it adds up to about 25%.
So we need some kind of streamlined cost component to assumptions to make them more viable for lenders. I mean, reading through the tea leaves, I think from HUD, we're going to get the MIP reduction and that's it. And you could tell, just by the way they're talking, like they're trying to figure out where to get the money for that, not like counting against like, oh, the funds at higher levels. And Rob, something else I wanted to talk about is the news that broke this week that G fees likely going up to pay for the lower delivery fees. And I we haven't really talked about it in detail. I should have assumed it. What is that dog in the background? But
Another drug sniffing dog in my
the dogs
anyway,
love
go on,
working out. You're big with the
Some milk-bone underwear. I'll send you some for Christmas.
But basically saying, the increased fees on the second homes and the cash outs, like 1/1000th of the reduction of the fees on the affordable stuff. So it's like G fees going up for everybody is what it seemed like at least the column I read. I don't know if you've heard anything different.
Yeah, eventually things come to pass. And I know the FHA MIP premium, we've been talking about that for months and months and months. At some point that'll change, loan level price adjustments. I mean, things grind on. And so, it's good, but it's nice to pay attention. I think it's important for people on the call to pay attention to the potential changes that may take place. But once again, as I travel around, I talk to a lot of originators. They're kind of half interested in what might happen and more focused on what their company can offer now, because they're in a tough spot right now. And so some loan level price adjustment might change a couple months down the road or 6 months down the road, or maybe FHA insurance premiums might change. But for right now, heading into, definitely we're in the autumn, if not winter. We're in autumn in California, winter obviously in Twinsburg, Ohio. But it's going to be long several months. And so originators are really focused on trying to get their companies to offer, once again, HELOC, seconds, Federal Housing Authority. Bond programs, reverse programs, construction to perm programs. What can they do now to help their borrowers now? Tom, what do you? I know I published a piece or two regarding you and your survey and so forth. What was your general mood? What was your general, in a paragraph or less? How would you sum up Nashville, the national conference in Nashville? What was your takeaway?
If I pick a specific word, it would be sobering. I think that my conversations with people left me to believe that there's a great deal of concern about what the balance of this year and next year are going to look like. That there's still going to be a lot of shrinkage within the industry as a result of a 50% retraction in aggregate activity. And so we've fallen back against hard times. It's going to be a difficult period ahead. A lot of people expect interest rates to remain very high, the economy to remain lackluster, if not fall into a recession. My conclusions were unfortunately on the negative side in that piece that you referred to in the report that I wrote up.
And just so listeners know, Tom's been doing a survey of, 30, 40 really key industry leaders every year at MBA secondary and MBA annual. So it's a great, for those that are lucky enough to get a copy of it, a great every 6 months snapshot on the vibe of the industry. And there was a lot of interesting stuff in there. The one stat about, I think it was like about 70% of the respondents said they still expected more layoffs all the way into 2023. Like 70% expected Rob's boy, Matt Ishbia, to go under in like 3 years. It was, there was some interesting stuff in there.
Yeah, a lot of concern about consolidation within the industry as it pertains to ICE Technologies' proposed acquisition of Black Knight. A lot of disconcerting things happening in the industry.
We tried to get Anthony Shee on to discuss their quarterly losses of 140 million last quarter, but we were no response from his people. So
From the Azores.
So, but yeah, Tom, no, thanks for coming on and
Pleasure.
expanding upon that, because the survey is great and it's great information, and you do a great job with it. Really appreciate that.
Many thanks.
Absolutely. So, what else, Rob? You're in your travels around the world. Any news of note as we take it into the weekend here? You're on mute, or I can't hear you.
How's that? Is that better?
Here you go.
Yes.
I get to go to a Warriors game tonight. That'll be fun.
Probably got the seats real cheap because of their start being so horrible.
Yeah. Yeah. Well, the owner of the tickets paid me to take them off her hands.
Always works, yeah.
Yeah. No, and there's no, I'll echo Tom's sentiment to some extent, but yeah, it's sobering, but I think a lot of the people who have been in the business a long time and will continue to be in the business a long time, they're pretty pragmatic about the whole thing. They realize it's tough. They also realize that somebody's going to do $1.5 trillion or $2 trillion worth of mortgages next year. And why not have it be them? And in the meantime, cut costs fast enough to keep up with declines in revenue and volume, and just kind of gird your loins.
We've had a lot of success stories these last 4 or 5 weeks. Small, medium-sized lender members of ours, like big wins in the recruiting wars, bringing on 10, 20, 30, 40, 50 LOs to companies that aren't huge. Again, these small to medium-sized companies that are well-run, good leaders that communicate well, that are in a good cash position and aren't worried about the next, thinking people that can look at this industry right now and be like, man, hey, if it's like this for the next year, so be it. I'm ready for it. Like, those are the people right now you want to be marching behind in my mind. So,
Yep.
But,
Yep.
Any Tom LaMalfa, any parting thoughts for the audience as we take it into the weekend?
No, not really. I'm thinking a lot about the FTX failure and what's going on in the crypto market. I think that makes for a very interesting backdrop against the volatility in the bond and the equity markets. And so I'm sort of taking that with me over the weekend. And then I've got to write a piece. Seeing Rob there, I've got to do a piece on a presentation that came earlier this week from the OMBA. They had a workshop on affordable housing, and I want to write that up and see what I can glean from that as I go through my notes. So that's really it. Other than that, just kind of a rainy day here in Cleveland. Not much different than Twinsburg.
So there we have it, Rich. Tom LaMalfa working, flipping 7 days a week, nose to the grindstone.
He's a Clevelander. We're tough. I mean, that West Coast highfalutin, travel all around, couple hours of working, record a podcast. I mean, we're grinders in the Midwest, me and Tom.
Yes, sir.
All right. Until next
Okay.
Friday, thanks as always to our audience for wrapping up the week with us. Podcast, search TMC Connect, YouTube. We're everywhere. And we'll see you next Friday at 3 p.m. Eastern. Have a great weekend,
Thank
everyone.
you, guys.
Take care, guys.
Bye.
Bye, Tom. Bye, Rob.
Bye-bye.